do that. Yeah. Good. I learned something new.
So I think people are going to continue to join. I think it's 3 minutes over. We can wait for one more minute and then we can probably get
Absolutely.
started.
No problem.
All right, I think we can begin. So, welcome everyone. My name is Sam Merchant. I'm the president for San Antonio Indian Nurses Association. Based on the needs assessment of our organization, one of the things that came up was nurses and healthcare workers wanted education on financial health and financial planning. So Saina really decided that we will partner with organizations that are in San Antonio that are willing to provide that education to the members so that we can actually look after our financial health. Just this morning, we finished an education session with Credit Human on basic financial education and planning. And so, thanks to Ms. Roshan, who actually reached out to me and said we can help Saina members get this education as well. And so, when she was chatting with us, we realized that all the stuff that they were trying to say was a little higher level stuff that Credit Human was not going to cover. So, I thought, yes, that's a perfect opportunity to bring Ms. Roshan's team to actually provide this education to our members. So thank you. I think Nadia Kurji was one of our members that actually introduced Roshan to us. And so we're grateful for this team to provide this education for us. So we have with us Mr. Sam, another Sam, Mr. Salim Sayani, who goes by Sam. And Mr. Salim will actually take us into the education session for financial health. We are going to be doing this session for the next 1 hour. So once again, thank you to the team, Ms. Roshan and Mr. Salim, for being here and giving us this information. Over to you, Mr. Sam.
All right.
Thanks for having us, Sam.
Thank you, Sam and Roshan, for this opportunity. My name is Sam. I'm a certified licensed finance professional. I'm certified in the state of Texas to give out education and other financial concepts to institutions and teams that really require that and help them make a good financial decision. The way I put it, I normally tell them that we try to be certain in uncertain times. The reason being, the market is so volatile, and right now the finances of everybody else is so different that it's very hard to decide which way to go, whether to invest, not to invest, or which way to take or what route to take. So having said that, let me share my presentation. And if you have any questions, feel free to write in the chat box. And at the end of the session, we'll try and take care of those questions if it is something that can be discussed in the group. If it is something that would require personal attention or individual consultation or something, feel free to reach out to Roshan again, and we can do a one-on-one session, and it's absolutely free. Our goal basically is to create a financial awareness and a financial presentation so that families are not left behind and they can take an educated guess or educated decisions. Okay, so
Sam, excuse me, Sam. There is a message coming here. This meeting is being recorded. Can you take out, because we cannot see the screen? I don't know if it's the same with everybody.
you cannot see my screen.
If
No, your screen is shared and I'm able to see the screen. So maybe you can try to reshare.
Yeah.
Yeah, when it says the meeting is
no, it is being shared, but does everybody see this message, or it's just me that
everybody, it's a disclaimer that Zoom provides, so you just have to say agree. If you don't agree for your recording, then you can come out of the room, but this is just a disclaimer from Zoom that the meeting is recorded, so you just have to say yes and continue.
Okay, everybody. Okay, all right, thank you.
Thank you again, Sam, for that help. All right. So financial freedom is what everybody wants to achieve. Okay. If I may ask a question, and I understand that everybody cannot answer on the Zoom right now, but ask and answer yourself that how many of us want to save taxes? How many of us want to be wealthy? How many of us want a good retirement? How many of us want our children's future secured? The answer is yes. We come with this country with a dream for us and for our family, and we want to make sure that our future is secure in this country. And having said that, there are lots of financial concepts that are available which make you aware as to where and what we can do to make sure that our future is secured. Uh, like you build a house, there's also something which is called a financial house, and which everybody wants to make sure it is secured again, right? So if I may say that you're going to planning for the unexpected expenses or unexpected, you want to make sure your house is building with a big and a strong, solid foundation. So whenever your foundation is strong, the building on top of that will be very, very complete and will not fall for anything that comes up, right? So what is the first thing that you need in the foundation? That is protection. You want to protect yourself from your income. You want to protect yourself from all the wealth that you achieve. You want to protect yourself from all the money that we owe and any other thing. But you want to make sure you are so well protected that tomorrow, when it comes to retirement, you are well established. The other thing you want to always make sure is to ensure that you have your lifestyle the same that you would always have. And for that, you want to make sure that you have no debts. You want to complete and fulfill all your debts. Debt is like a hole in the bucket. The more debts you have, the more problems you're going to face. So the first goal you should want to do is get and eradicate all the debts. The other thing you want to make sure is prepare for the unexpected. So you want to have some emergency funds. And after having all that saved and done, investments. So what happens normally is 20% of your funds or income, you should put it on the side for emergency funds, for rainy days, for next 3 months to 6 months. COVID is the best example that we have seen. In 2020, when COVID hit us, a lot of Americans had a problem. If there were no checks coming from the government, you would have seen a lot of problems in this country. Emergency funds is a really key for our unexpected and rainy days. And once the money is left, then you think about investment. But be honest to yourself. All men, especially, I don't know about movement so much, but mostly most of the men, the moment they have some free funds, they want to go ahead and invest somewhere else to create a secondary income. And that is the case where we all fall in a trap. The moment we have some extra income, we go and invest somewhere, not realizing that that investment in future can be a problem or a hazard for us. We come to this country, and what we do is we want to try wealth, build wealth for our future, for our family. So how do we accumulate wealth? Okay, it's a very simple formula which is universal. You can go anywhere in the world and this formula will apply. The first and foremost thing you want is money. You want money and you multiply that by time. So the longer you keep money invested in any of the vehicle you choose, you are bound to create wealth, provided you have a rate of return that is always positive. When you get more rate of return, the more money you're going to accumulate over a period of time. But rate of return can be positive and can also be negative. Sometimes some investments come in and those investments don't do well and then they fail. So your wealth will deplete. So you want to make sure that your money is growing over a period of time with a positive rate of return. The other thing that kills it is inflation. Inflation, as they say, is a silent killer. Nobody realizes when they're accumulating wealth or they're counting their money, they forget the part of inflation. Inflation is a silent killer. You want to make sure that your money is growing more than the inflation rate. In America, the inflation rate approximately is around 3.2% as of now. The other thing that kills everybody is taxes. You cannot avoid taxes. Taxes is something that you have to make sure that gives you enough returns so that you can pay off taxes in proper way. At the same time, you want to save taxes as well. Nobody likes to pay more taxes. Everybody, anybody you go to see, they like to they like to save taxes. Nobody wants to pay taxes to the government, right? Because there's extra income that you've earned and you want to save all that. So the wealth formula is money plus time and plus rate of return or minus rate of return, right? Minus the inflation, minus the taxes will give you wealth. So you want to make sure that you accumulate wealth. Now, how do we do that? How do we accumulate wealth, or how do we make sure that the rate of return that we are getting is very good? So there is a rule in the financial world, which is called the rule of 72, which was invented by Albert Einstein. And he calls that a mathematical wonder or an eighth wonder of the world. He says, he who understands this formula will earn it. It's a very simple rule. Anybody can understand that. You take the number 72 and you divide that by the rate of interest you get. Whatever the number you get, it will take you that many years to double your money. So for example, you take 72, divide by 2%. If you get a 2% return, then at 2%, your money will double every 36 years. So if I invest $10,000 today at the age of 29, after 36 years, that is at the age of 65, my money will double to $20,000. I don't know if that is the rate of return you want. Okay. Then there's a rate of return where you can get probably 4%. So the money doubles every 18 years. 72 divided by 4 is 18, right? So what is going to happen now? The money is going to double because at 2% was 20,000. So at 4%, it's going to be 40,000. Now, if I ask you a question, you can answer to yourself, what would be the amount be if it was 8%? I know most of you must have answered as 80,000, but that is not the right answer. The right answer is $160,000. The reason being that the money is compounding. So the compounding interest helps multiply your money. Why it compounds? Because whatever your principal amount is, you add a rate of return on that. So now your new principal is the old principal plus the interest that you earned. So then your new principal is a higher amount, and then you get 8% on that again. So a new principal comes up again, and then you keep multiplying that way. And you can see that the same years of between the age of 29 to 65, 36 years, at the rate of 8%, instead of making $20,000, you could have made $160,000. But he who understands this will make money. People who don't understand will pay the price for that. How? If you go in downtown, any city in the downtown in America, so say San Antonio, for example, right? What are the two tallest buildings you're going to see? It'll be one of the banks or it'll be one of the financial institutions. You can go any city in America, and this is what you're going to see. Banks know how to multiply money, how to make money. So, and it's a very simple example. When you go into the bank and you invest money, what is the rate of return they are giving you? A 2% on a savings account or a CD or a money market account? Less than 2% now, right? But if I take a credit card from the bank, how much are they charging you? 16%, maybe 18%, sometimes even 24%. So they know how the money works. They are charging you 24%, whereas on the back end, they're giving you only 2% or even less than that. So they know how money works. So it is very important that you realize that you do not have any debt. If you have credit card debts, you want to pay it off as soon as possible because the rate of return that you're paying on credit cards is very, very high. So you don't want to do that. Okay. That leads us to another concept, which is a very powerful concept, and that is called, when does your 50% cost give you 100%? So what happens is, whenever you make a loss in any of the vehicle, any of the money that you've invested, it costs you a lot more to get that money back. And let me give you a simple example. If you have a pen and paper on you, you can use that. So say, for example, if I give you $10,000, I can give you $10,000, and if you invest that on the first year, you make a loss of 50%, 50. You lose half the money. So you make a loss of 50%. On the second year, you gain 50%. Now, most of the financial consultants, they're going to tell you, if I lose 50% the first year and the next year I make 50%, what will be my result after 2 years? Most financial consultants, Vanguard or Voya, or you can take anybody, and they'll say, oh, well, it will be minus 50% plus 50%, the result is zero. So you'll be where you are. But that is not the truth. When you put the number to the percentage, the results come out very different. Okay. So say, for example, I put $10,000 here. I lost 50%. I lost $5,000. So my end value is only 5,000. The second year, I'm investing 5,000 and not 10,000 because I lost 5,000. And my returns are 50% plus. So I'm only making 7,500. So in reality, I'm 25% loss. I'm losing 25%. So to make that 50% loss that I made in this year, I have to make a gain of 100% to recover that 50% loss. So if I make a loss in the first year for 50%, in the second year, I have to make 100% to get back my $5,000 so that I can be back to $10,000 where I was. So that is why they say in the financial world, losing money is not an option. You don't want to lose money. One loss can take you back 5 years, 6 years, and even more for that matter. So you have to be very, very conscious about where are you investing your money, and losing money is not an option for us. So having said that, what should we do or where should we invest? Because there are so many avenues that are available to us, and it is very difficult to choose those vehicles, right? So I've classified this into three different categories, which you normally see in a financial world. Okay, the first way to invest is called a fixed way of investing. A lot of people put their money in the banks, okay, at a fixed rate. Why do they do that? Because they want safety of their money. Tomorrow something happens, there is an emergency, they can always go to the bank and remove the money, right? So they have safety of the money, and that is the reason they want to invest in a fixed manner. The second way of investing is a variable way of method. Where do the variable method do? They invest in stock market, they invest in 403b, they invest in 401k, they invest in IRA, they invest in mutual funds, okay? They invest in annuities. All these are forms of variable investments. You can take names of anything you want. At the end of it, all that is being invested in stock market or any other market related like that. So at the end of it, it is variable. Now, why do people invest in variable market? The reason is very simple. The gains are higher, the profits are higher, but it is a risky proposition because nobody can time the market. Even Warren Buffett lost almost $52 billion almost 3-4 months ago. Even he timed the market. Who he's supposed to be considered the best person or second richest person who knows how market runs, and yet he lost so much of money because when COVID came in, nobody was knowing that COVID is supposed to come, and the market dinged 29% in one day. 29%. That's a big, big drop. If you remember 2008, market dropped 39.48%. They call it a Black Monday in October 12th, right? So people have lost a lot of money by doing this. But at the same time, I'm not saying it's a bad proposition. Overall, you will make money if you stay invested in the market. It's very important that you understand, and what is your risk tolerance depends upon you. So if you are very young, your risk tolerance is higher. If you are at an age which is like 50 plus, then your risk tolerance is less because you do not have so much of time to recover those losses back. As I showed you earlier, one loss can take almost about 5 to 6 years to recover back. So you do not have the time to recover that. So what did the industry do? They came up with another way of investing, which is called indexed way of investing. Now, what happens in index way? They get the growth of a variable market, okay? At the same time, they have a safety of a fixed market. So when the market is going up, your money is growing, and when the market drops, you stay flat. You lock yourself, you lock your growth. So you are secured, okay? Your safety comes in play. So let me show you with an example how that works, okay? Now, suppose you have $100 to invest, and you're investing in a variable market, right? The market goes up 10%, you're going to make 10%, which is $110. The market went up another 20%, made another 20%, which is 132. Then you made one more 10%, and now you are sitting at 145. 3 years back to back, you made good money. But now suppose if you make a loss of 40%, you're losing 40% of 145, and not 100. Remember that. You're losing 40% of 145 wherever you sit, right? When you lose 40%, you're down to $87. Versus if I invest the same $100 in an index formula, what happens in an index formula? You have a cap and a floor. So cap is a 15% cap, for example. Some companies give you 13%, some give you 17%. It depends upon the market. And every carrier, like Voya is different, Vanguard is different, Charles Schwab is different, um, Fidelity is different. So everybody has their own way of having their caps. But the bottom line is that your floor is zero. What it means is that you are never going to make a loss. No matter if the market goes down 30% or 50%, doesn't matter. You'll never make a loss. So let's see how the money grows here. You have $100 again, like the same variable market. 10% the market went up, you made less than 15%, right? So you made 10%. The market went up 20%. Roshan, you want to mute everybody else? When the market went up 20%, okay, because you are at a cap of 15%, you don't make the 20%, you make only 15%. So you are losing some money at this compared to the variable market. You had 127 versus 132. You made another 10%. Now, instead of 145, you're at 139. But look at that, what happens now. When the market drops 40%,
Mr. Salim, hold on. It's Mr.
40%.
Tojo. Mr. Tojo, could you please mute your line? We are hearing your background noise. Mr. Tojo Chorat, please mute your line. Or Roshan, if you, oh, there you go. Thanks.
Thank you so much again. So if the market dings 40%, you are not dropping 40%. You are going to stay where you are at 139. So here you are at $87. Now you're at 139. Now when the market goes up again, you start your journey from $87 again, go 10% up, you make $96. Whereas in an index way of investment, what happens? You start your journey from 139, make 10%, your growth is 153. So that is the power of indexing. In a long run, you will always come out ahead. The reason is you can see the index of American stock market, right? It goes up and down like a heartbeat. Okay, every 5 to 7 years, the market goes into correction. So what happens when the market goes into correction? People start losing money. But if you are invested in an indexed way, you are never going to lose a dime. It is guaranteed you will never lose money in this format. So that is also one way of investing, which you should keep in mind. And once you know that, you can make a calculative decision as to how you want to invest your money and where you want to put your money. Okay. Now, as I said earlier, that once you make one loss, this is just an example that shows if the market went down 40%, you will need 67% growth for next 6.5 years at the rate of 8%. At the rate of 8% for next 6.5 years, if the market keeps growing at the rate of 67%, then you're going to recover your loss. It takes you that long to recover just one loss. So imagine if you have back-to-back losses, which happened in the year 2000, 2001, 2002, when the market kept going down 3 years in a row, a lot of people have lost their money. So I've made a chart which shows the 3 different kinds of investment that I just showed you. And this is the real numbers from the year 2000 to 2019. It's a 20-year chart. And if I was investing $100,000, say at a fixed rate of 4.5%, okay? So how the money grows, I get a $4,500 growth. So my investment now is $104,500. Then that $104,500 is invested at the rate of 4.5%. I make $4,700 and it keeps growing. What is the bottom line? My spendable money is $130,000. Let me move this cursor a little. Okay. So my bottom line spendable balance is $163,996, almost $164,000 over a period of 20 years at an investment of $100,000 with a fixed rate of 4.5%. Now, if I had invested the same money in a stock market, okay, so this is S&P 500 index, okay, again the same from year 2000 to 2019 for the next 20 years, if I am invested, look at that what happens. Okay, so the year 2000 the market dropped 13%, so I lost $13,040 on $100,000. Now don't forget, whenever you are dealing with your money with stock market, the companies that are assisting you, be it Vanguard, be it Fidelity or Voya Financial, Charles Schwab, they all charge you a management fee. And normally a management fee runs anywhere between 1% to 2%. So I took into consideration 1.5%. Okay. When I take that 1.5%, okay, my money goes down because I dropped 13%. So my 100,000 became $85,000. So as I showed you previously in the example, now I have $85,000 to invest. I lost another 10%. I went to 75. I lost another 23%. My portfolio became $57,000. So my $100,000 in 3 years became $57,000. But came the year 2003, where the market grew 26%. It grew up 26%, which is a great phenomenal growth. So I made $15,000 and tried to recover some of my losses, went to 71, then to 76, came to 88,000. Unfortunately, came 2008, where I lost 38.49%. There was a big, big drop. My money went back to $53,000. Then came the longest bull run in the history of America. A lot of people made good money on this. We had a long stretch of making money for the next 10 years. The market rose 33%, 32%, 31%. But at the end of it, if I average out all 20 years, I still made 6.55% growth. It is still better than 5%, which is good, because if you don't make 5% or more, you're not even beating inflation and taxes. To beat inflation and taxes, your return on money should be at least more than 5%. Okay. So after paying all the fees and taxes, what is my net spendable money? $130,000. Okay. So my fixed return actually at 4.5% came out better, right? Now, had I invested the same money in an index format, okay, so let's see what it looks like. So I have the same $100,000 in S&P. I lost 13%, but if I have a floor and a cap in an index format, as I explained earlier, I'm not losing a dime. So my cap is 0%, which means I did not lose any money. So my 100,000 stayed at $100,000. The next year, 100,000 again, they stayed at $100,000, right? The fourth year came when the market rose 26%, but because I have a cap of 15%, I made only $15,000, but I'm just above the level, so I'm at $115,000. Okay. Whenever the market goes up, I keep getting the same rate, except whenever it rises over 15%. Then came the famous 2008, the Black Monday in the history of America. 38.49% the market dropped, but I did not lose a dime doing business. I stayed at 151 the same way, right? So 151 is what I made again. So what is my spendable amount? And again, remember, when you're doing an indexing contract, you are not paying any management fees. So my net return is almost 8%. So my spendable money after taxes is $302,000, double of what I had invested in other formats. So it is a no-brainer. Why? Because you don't want to lose any money. Losing money is not an option in a financial industry. So it is very, very important that we understand how money works. Okay. There are in anywhere you go in the world, universally, there are three issues of money. People have three problems when it comes to money. One, they want to make sure that the money grows. They don't know how to make money. So they want to make sure that they make money or grow their money. The second thing is to find a way that to grow their money. So first is to make money. The second is to grow their money. And the third one is to hold on to their money. People don't know how to hold on to the money. So when it comes to retirement, you want to make sure that you're holding on to all your wealth and all your money, right? So this is how I have strategized that investing could be a blessing because you're not losing any money. Okay. The other factor I mentioned to you about to create the wealth was inflation. And as I said, that inflation is a silent killer. There is no way to hold on to inflation or avoid inflation. It's going to be there in the market all the time. So far as it is less than 3%, it is bearable. But when it countries that have a lot higher inflation, especially most of you are from India and Pakistan, I believe. India is right now struggling because of the very high inflation rate, right? So it is very important that you understand how inflation works and you control that. It's a silent killer and very simple. I mean, the $100 you could buy a lot of things before 20 years ago, and today with $100 you can buy hardly anything you want today, right? So it is the lifestyle has changed, the cost of living has changed, right? Other factor that affects your wealth is taxes. And again, I tried to classify taxes into three different buckets so I can explain better. They say the more diversified your portfolio is, the more diversified your taxes are, the better it is for you. You have a balanced financial life. Okay. So, for example, the first bucket that I put, and I call that a tax now bucket. What happens in a tax now bucket? You have your W-2s at the end of the year or 1099, whatever you get, plus you add your additional income like your mutual fund income, your CDs, your stocks, everything. At the end of it, you give all that to your tax accountant or your CPA, or and they make a tax return, file it, and then you pay your taxes, and you're done with it. You get a spendable money of so much of amount which you can use it. So all your money is after tax dollars. See, so all your growth that has been done has already been taxed. You have to pay no more taxes on those things because it's already been taxed, right? But the second bracket, and most of us fall in this bracket, by the way, a lot of people fall in this bracket. The second way of taxing is taxing later. Now, this is a very good avenue to save taxes for future. You defer your taxes. So it's not saying that you're not going to pay taxes. You're going to pay taxes, but you're going to pay taxes later. Now, a lot of CPAs and accountants suggest to us to go and buy an IRA for $5,000 or $6,000. The limit on IRA is $6,000. Individual limit is $6,000 today. But there is a restriction, right? And an IRA. Same thing, a lot of companies allow you to invest in 401k, or a lot of hospitals and schools allow you to invest in something which is called 403b. It's the same thing as 401k. Now, what happens here is that the hospital that you work with or the schools that you work with, they match a certain portion of your investment. This money is before taxation. So whatever money you're putting here, see it says you're putting before the tax dollars. Okay. Now what happens here is when you put $5,000 and your employer say is matching another $5,000, so you get free money to invest. Hands down, you should take it. It's a no-brainer. You always take the free money. So if your employer is giving you 5,000 matching to your 5,000, take that 5,000 always. It's a no-brainer. Take it. Okay. Now what happens is that you want to understand is how the taxes will affect you. Okay. So this investment of 10,000 now, 5,000 yours and 5,000 your employers, the 10,000 is invested. Don't forget it's a retirement plan account. So you cannot withdraw that money in few years. You have to get invested and stay invested till you retire, which is at the age of 59 and a half, and you can take the money after that. So you're invested for at least another 10 years or 20 years or maybe even 30 years, right? So this 10,000 now becomes $200,000 after 20 years. So what will IRS do? They will charge you tax on the $200,000 and not on your $10,000. It's very important to understand. A lot of professionals I've met, I've done this presentations in a lot of other places, and a lot of employees had a feeling that they are not going to pay taxes. Please correct yourself. You will pay taxes, but you will pay taxes when the money is grown and you're starting your distribution, or when you're withdrawing the money. There is a famous principle which IRS uses is called an RMD rule, required minimum distribution. You can Google and you can go into irs.gov and look at it and read on that. Anytime you reach 59 and a half, before the age of 72, you have to start withdrawing your money. If you do not withdraw, IRS is going to charge you 50% penalty. 50%. half of your money will be gone. So it is very important that you understand that the money that is growing will be taxed later on. So it is not free money for you. Okay, the 5,000 you already got free money in the beginning for investment. You should take it. I'm not against 401k. I like 401k. In fact, I have 401k plans myself. So you want to invest because your employer is matching certain funds, but you do not want to overfund it. So on a 401k or 403b plan, the limit is $19,500 per person for a year. So if you're investing, say, $10,000, and the employer is matching on based on the $10,000, you don't want to invest another 5,000 or another 9,500 in the same plan, because now when you're investing more, your employer is not going to match that. So this is your investment that is being invested, and IRS loves that because they know in future that 9,500 is going to become 90,000, and they will start charging you taxes on that. So you are partnering with IRS, I may say that. So I know jokingly, I normally tell my client that you're making IRS your partners when you invest in 403b or 401k plan. But be calculative about this. Be very mindful about this. How much are you investing, and how your taxes will affect you. But there is also a tax bracket which is called the tax advantage bucket, which a lot of rich American people use it, because on this bucket you are not charged any taxes. All the money invested here in Roth IRA or a life insurance retirement plan, it's called LIRP, life insurance retirement plan, or very popularly known as 7702 plan. Okay. 401k, by the way, 401k or 403b, these are all IRS tax codes. These names are IRS tax codes. That's what it's called. So it is called here 7702. Okay. Now, when you invest in Roth IRA, first of all, you need to qualify. The limit on Roth IRA again is $6,000. You cannot put more than $6,000. Sometimes, depending upon your income, if you're a doctor or a nurse, you're making more than $196,000, you will not even qualify to invest in Roth IRA. So what is the option left? You want to invest in this 7702 plan, which IRS allows you. And the best part of this plan is all the money that you withdraw on distribution or whenever you want to withdraw is tax free. You're not paying a single dime tax on this money. You're not paying any money. So what I suggest to my clients is you diversify your portfolio. You put 20-30% here. You put about 35-40% here, and then you put another 20-30% here. So you diversify your taxes. The reason is when you are retiring and at the age of 59 and a half or 60 years or 65 years, when you're withdrawing the money, you will pay some taxes on that money, and on some money you're not going to pay taxes. So you're balancing your portfolio. You see that? So the more diversified your portfolio is, the better it will look. So having said that, you want to invest in 401k plan to the amount your employer is matching, but do not overfund. All the money that you want to overfund or extra money, if you're left with, you invest in this bucket. Okay, and you can get the same returns with tax-free advantage. Plus, there is no penalty to withdraw it earlier. Okay, so it's a very good bucket to think about. Other thing I wanted to stress upon is the tax rates. Do you know what is your tax bracket going to be next year? Nobody knows that. We got all this money from the government for last 2 years because of COVID. The government right now is in a hole. How do you think the government is going to make some more money? Taxes. They will increase the taxes. Historically, if you go to irs.gov, you can see this chart there. There were times in 1944 in World War II, people have paid 94% taxes. In 1954, 89% taxes. In Reagan administration, the taxes came down to 37% and 34%. Okay, Bush administration, it came down even further. Right now, we are at a very good tax bracket rate. We are at 37%, depending on wherever you fall. Okay, most people fall in between this bucket here, 22 to 32. The very rich people fall in 35 and 37%. Right? So right now, we are at a very good tax bracket rate. It is like me telling you the tax laws keep changing, and it could have a huge impact on our investment and on retirement portfolio, because we don't know what our taxes will be down the line after 10 years or 20 years. So if I say, for example, if I give you $1,000 today, I said, hey, Sam, here's $1,000. Take it, enjoy it yourself. When you're ready to pay me back, I will tell you what is the rate of interest going to be. Will you borrow that 1,000 from me or 10,000 from me? There's no way you're going to borrow that, because you want to know how much you're going to pay. Right now, you know what you're going to pay. So the question is, do you want to pay taxes on the seed amount, or you want to pay the taxes on the growth amount?
Mhm.
Some portfolios, you'll be surprised if I tell you that at an investment of $250,000 contribution, your distribution can go as high as more than $1 million in the next 20, 25 years. See, if you, on an assumption of $10,000 annual contribution for 25 years, your investment can look this, $1 million. Do you want to pay taxes on $1 million? Or you would rather pay taxes up here and invest the other rest of the money on the third tax bracket and save all that money as tax-free money, right?
Mhm.
That decision, every individual have to make yourself, right? So to re-emphasize my point again, when I'm investing into IRA, a traditional IRA or 401k or 403b, I'm not paying any taxes here, 0% on taxes when I deposit the money. So when I invest 5,000 or 10,000, not paying anything, no taxes. But on the whole growth, when I'm removing the growth on distribution, I will be taxed ordinary income tax on a withdrawal. Whereas if I invest in a Roth IRA, or what I told you about the 7702 plan, I'm investing I'm investing after tax amount dollars, okay? And when I'm withdrawing that money, I'm not paying a single dime to the IRS, 0% on the distribution. So very important point to keep in mind. You also want to make sure that when you retire, a lot of people think that you may not have so much of income, so I may not have to pay so much of taxes, but that's not true. What happens now, when you're young, you have children. So you have tax credit, you get exemptions on children's investment, right? You also have some plans like 403b plan or 401k plan, which is tax deferred. So you're saving taxes on this. You also have a house probably. So you're saving on the interest on mortgage, right? You have some charity that you can write off. When you grow older or when you're retiring, all this is not going to be there. Your children may have grown up and they may be on their own. You cannot claim them anymore. Your 403b plan is at a point of distribution now, so you cannot defer your taxes anymore. Your house may be already paid, so no more interest write-off on mortgage. So even though your income may be less, you might be in a higher tax bracket based on what you made. Okay, so something very important to remember for your retirement purposes. I also made a small chart for you guys to show you how the 401k plans works versus the 7702 plan, which is regulated by IRS. Okay, so this is a simple example of one of my clients. He and I compared it with the 7702 plan. Okay, over here on this left side, I'm giving you the 401k plan, or which is also called tax deductible retirement plan. Okay, I'm assuming that that the tax bracket or tax rate is 25% approximately. Okay, and the growth rate on the 7702 plan is at the rate of 6.27%, and my initial payment is $1,000 a month or $12,000 with a death benefit of $500,000. Now you know that there is no death benefit plan in a 401k plan, right? So when I'm investing $12,000 after taxes, which means before tax, I have to invest $16,000. So when I put $16,000 in a 401k plan with 25% taxes, my money invested after tax is $12,000, right? Then my money is sitting here, and based on the market, the growth is 34% or whatever, right? And my 401k plan is put into this account and it keeps growing, right? When it comes to distribution, I pay taxes, and this is what I get after taxes, right? So in the first 10 years, okay, by paying $12,000 year over year, okay, I'm accumulating almost $134,000, right? In a 7702 plan, I'm putting the same $12,000 every year, okay? And my money is growing a little slower. So in 10 years, I'm accumulating $131,000, but I'm getting a death benefit. So God forbid in the next 10 years, something happened to me, my family would have at least got that $500,000 death benefit, plus whatever the cash value I've collected or whatever money is accumulated will also be paid to me in this plan, in 7702 plan. So I will make 631,000 versus 154, right? But my growth is almost the same, 134 here, 131 here. Now, if I look at the next 10 years, so till for the next 20 years, my growth here is almost $364,000 versus over here, my growth is $404,000. Now, mind you, I'm growing at the rate of only 6.27%. I'm not putting 8% yet. Okay, 6.27%, right? But the benefit here is the money is growing. Anytime I want to withdraw the money, I can withdraw money from this account, 7702, tax-free, tax-free. I cannot withdraw money from my 401k or 403b plan. If I do it before the term ends, I have to pay 10% penalty. However, recently they have relaxed some laws, so you can withdraw up to 10% without paying any penalty. But on a normal cases, soon once all the regulations go back in force, it will be the same thing here. You cannot withdraw without paying unless you pay a penalty. Now, what happens at the time of distribution? Always remember one thing: between the age of 45 to 65, you want to accumulate as much funds as possible. So whatever vehicle you choose, whatever portfolio you choose, wherever you want to contribute your money, always keep in mind between the age of 45 to 65, those 20 years, you want to accumulate. You want to accumulate. After the age of 65, you want to distribute. So after the age of 65, you want a distribution. So if I take a distribution over here, okay, so say for example, I take out $94,440, close to $100,000 every year from a 401k plan, right? What will happen? The money that I've accumulated will start depleting. See, start depleting. So I take out this money, it start depleting, and also the money is facing the market. So whenever there is a loss, the money will deplete. Okay. What will happen after 16 years or 17 years? 16 years or 17 years, my money has gone down and I have no more money left to withdraw. Versus the 7702 plan, I can withdraw the money with an income stream of lifetime. Lifetime, till you die. You can keep withdrawing this money till you die. And still at the same time, your money is depleting here also, but the money grows because you have a good death benefit here of $500,000 that stays around that much, even when you are taking away $100,000 year over year. See, when you take out 94,000, but the rest of the money stays invested and it keeps increasing. So your surrender value keeps decreasing. See, your money is depleting here, okay? Like it would deplete here too, but it does not deplete at the rate of the way this is depleting, and you still have some money left here, but you're getting a lifetime income stream guaranteed. There are companies who will give you a guarantee. There are products available in financial market which will guarantee you an income stream for life till you die. Not only that, if the money is left, your beneficiary will also get that income stream till that money is over. So there are vehicles available in the market. You just have to look for those. And of course, we can help you choose those to find where you can find those income stream products, where you can get an income for the lifetime. Okay. And still, if something happened to you, God forbid, you pass away, your beneficiaries still get this money. So your legacy is transferred to your loved ones, your children, or your husband or wives, or your family. Your money is transferred to them tax free. It's a legacy transfer, right? So having said that, the question arises is then where should I put my money, or where should I park my money, or what should my money do? So everybody has this question: what is my money doing? What are my options? Right? So I created this sheet, or something which I call that a test, an acid test for money, where I want to see if my money is growing, if my money is safe, if my money is liquid, which means I can get the money as soon as possible.
Mhm.
Do I get tax advantage? Do I get an income stream? I just explained what is income stream. Um, I just explained what is income stream, which means that the money keeps coming to you for the life. Okay, this is something. Living benefit is a good concept. Living benefit means that the some of the contracts in the market which are available, which give you a living benefit, which means they will take care of your chronic illness, your critical illness, and your terminal illness. Okay, so God forbid, right now you're very healthy, you are employed in the hospital, your hospital may be covering you for all your medical benefits. Tomorrow when you're not employed, what happens? Do you have that coverage? Is the coverage cheap or is it very expensive? You guys are in the field, you know how expensive medical bills are. One medical bill can wipe off a family. One medical bill. The most bankruptcies filed in America, 63%, is basically because of medical bills. So, living benefit is something that will cover you for your chronic illness, your critical illness, and your terminal illness. There are vehicles available in the market which will pay you whenever you're chronically sick or critically sick. They will pay you and they'll cover those costs for you. Say you have to be admitted to a long-term care or a senior home. There are places and there are vehicles which will cover you for those things. And those are called living benefits. And the other thing that is, can I transfer my wealth to my loved ones tax-free? Can I transfer my wealth tax-free? So I chose, a lot of people invest in stock markets. So does the stock market withstand that test? Stock market has a good growth, but it's not safe. It is very risky. It is very liquid. You don't have tax advantage because you have to pay taxes on that,
Mhm.
right? You do not have an income stream on that. You do not get any living benefits and you cannot transfer that legacy tax free. What if I invest in real estate? Yes, real estate has good growth. Safety, you can say yes and no. The reason is this, because tomorrow the market changes and locations change and places which are very popular at one time may fall down. For example, Ingram Mall, right? The place in Ingram used to be the thriving place at one time. Right
Mhm.
now, Anderson Loop and that whole area of Anderson Loop is growing leaps and bounds, right? So anybody who had invested in the real estate in those areas near Ingram Mall may be facing some risk now or losses, right? Or they may not be able to sell it. So safety can be yes or no for you. Okay. Liquidity, it is not very liquid because it takes time to get the money back. You have to sell the property, you have to engage a broker and to make sure that the broker charges you a fee and stuff like that. So it takes time to sell one property, right? Tax advantage, no, you have to have a pay a capital gains tax, and also if you make money you have to pay an ordinary income tax on that. Does it have an income stream? Yes, it has an income stream. Sorry, my bad. It has an income stream, right? Because if you put that property into a rental income, you can get a rental income month over the period of time, right? So it can have an income stream on that. It does not give you critical or chronic illness coverage. And also you cannot transfer that legacy tax free. You have to pay taxes on that. So the question is, what could be the product or vehicle which has all the greens, which checks mark all the green? So the question to you is, what vehicle should you choose? And there is no one option which is the best option. Okay, you can always compare and you can always have advantages and disadvantages, because there's no single product which will give you everything in one plan. One size fits all does not exist for everybody. Okay, there may be some which could fit one family but may not be fit for another family, right? So everybody's needs are different. So what should we do? Come to the conclusion of that, right? So the finances will vary for each individual family based on their needs and their investment strengths and choices. Everybody is very different. Everybody is very different. One family may be having a different need, and it's a small family of four, whereas there is a family of three or a family of five where their investments are way high in real estate and stuff like that, and they may need estate planning. Maybe very different need. Okay, So we are licensed professionals and approved in the state of Texas to provide solutions. We are mandated under oath by state to maintain privacy. So if you do approach us for a one-on-one consultation, so we give you, we'll be glad to personally go over individual questions and financial analysis for each family and offer solutions for free and no obligations, and make sure we maintain privacy on that, because there are so many other areas in financial planning that I could not cover today. All I did was today just give you a little glimpse or flavor of how financial concepts can affect your investment, and how, if you know those concepts, can help you. Okay. But then there are other things like a college savings plans or 529 plan. And a lot of people invest in 529 plan because they have been told that that is the best plan available in the market for their children to go to college. But people don't realize there are so many other plans that are available in the market by IRS that we can use. So just to give an example on college saving plans or 529 plan, whenever your child is getting admitted to college, they can apply for FAFSA. But the first question in the FAFSA is that, do you have any college saving plans? And if you say yes, or if they pull up by your social security number, then the grant that you're supposed to get from federal may be reduced, because they will use the college savings plan grant first and then give you rest of the money later on the second part, right? So you're losing out money because college saving plans is recorded by social security number. So anytime your child applies for college, they can pull it up. Okay. Also, college saving plans cannot be transferred to any other program or any other product. Like, for example, it can only be used for tuition or lodging or anything related to education. Nowadays, some cities and some states have allowed it to transfer it to siblings as well, so far as the money is being used for education purposes. Also, what happens is it is exposed to market. So what do the college saving plans money do? They invest, they invest in the stock market also. So the money can grow and money can go down also. So you're exposed to market. There is no security there. Okay. Likewise, wanted to talk a little more about wills and trust. Will is a very, very important document in this country. Extreme. If you don't do anything else, first thing you should do is make a will. It is not something that you handwrite it on a paper and just leave it for your family. That is, if it is not executed in a court of law or not prepared by a lawyer or stamped by a state court, that will is useless. Okay. Unlike back home in India and Pakistan, we used to have that privilege that, we had extended family. Something happened to you, your brother, sister, parents, even grandparents would take care of it, and legally the government would allow them to take custody of your children or any other property, or by will the child gets the money from the parents. Over here, that is not the case. God forbid, if you have younger children, smaller children, and if there is no will in the place, they can go into foster care. Something happened to you, if you do not have a will, the government will take the children and put them in foster care. It is very important. I have seen families suffer through that. If you don't do anything, if you do not have a will, I would really encourage you, if you don't do anything else, at least go ahead and make a will. I can put you to companies which will take half an hour and make you a will in 40 minutes, through a law firm, on an internet, answer all your questions and make your will, lock it and sign and seal and deliver it in 45 minutes to an hour. And they're not very expensive. They're not very expensive. This document doesn't cost that much, but a will is very important to put in place. Likewise, if you have a lot of investments and you have a lot of properties, estate planning is another key area. So going back to my question again is, where is your money parked? What is your money doing? Money, as I told you, has three problems, right? Everybody wants to make money. Everybody wants to grow money. Everybody wants to hold on to money. But how? That is a question. That is a test. Now that test for you individually, you'll have to make that decision where your money is parked. I just wanted to see if I can see Roshan. Yeah. So if you want to contact us, just please text Roshan at this number 210-663-9637. And that's our email address, roshanmogul@hotmail. Okay. And please make sure you mention Saina as a referral so we know where you're coming from. Okay. And that concludes my presentation. If there are any questions, Roshan, we can take that. Um, but and I can answer those for you. But anybody who needs any other assistance or needs help, or if you have questions or something that they need to know more about, you can definitely approach Roshan or text her, and then we can take it from there. There's one question that is up here. Is there a qualification criteria for products related to life insurance? People who are at risk of dying early would not qualify. Is that correct? Um, yeah, when it comes to life insurance, and that's a very nice question, actually, Sam, a very important question. People have not realized the value of life insurance. Life insurance has changed and evolved over the last 20 years to a very different level. Life insurance contracts nowadays cover not only just the death benefit, but they also cover living benefits also. The critical illness, chronic illness, the terminal illness is covered. Now, depending upon the illness that you have, life insurance companies, some are very liberal, so they may accept it and they may still qualify you and give you an insurance policy. Some companies are very strict about it. So it varies upon the company and also varies upon the amount of life insurance you want. So whenever it is less than 500,000 or 400,000 or less than a million, some companies don't even do medical nowadays. They don't even do medical. They rely upon the medical results which your doctors has provided and which is sitting in the MID, and they use that as a backup and then they qualify you. Okay. Some companies who are very, very strict, they really want to see the background. They want to do a blood work and stuff like that. So they're different. Everybody's different in here. Okay. So to answer the question, yes, there is a little qualifying criteria for all life insurances. If they have been diagnosed with a terminal illness or they know that she's going to die soon, um, yeah, they may refuse you to give the insurance. And some company, they are very, very liberal. As I said, they will give you an insurance, but they'll charge you arm and a leg. So most companies, don't insure people after the age of 70, but there are some companies who insure people even at the age of 70, but then they charge you a whole lot of premium for that because they are risking that much money upfront, right? So yeah. Oh, thank you for presentation. Oh, thank you so much again. That's very nice words. Yeah. But any other questions, if you have, feel free. I mean, I can answer them if they are general questions like what Sam questioned. But if there's something which you want to discuss on a personal note, feel free, just reach out to Roshan. We can set up an appointment. It's free of charge. There's no obligation. Our mission basically is to impart financial knowledge and share with you guys concepts that will help you make an educated decision and educated guess. Okay. With that, Sam, I'm done.
Uh, Mr. Salim, would you mind commenting on cryptocurrency and what are your thoughts on crypto?
Oh, wow. Uh, Crypto is a very volatile market, but it is the money of future. So, um, if you ask me, I have invested in crypto myself also. And I know a lot of other financial professionals who have invested also. Yes, it is risky right now. It is fairly green still. But at the same time, if you really go to see, digital currency is going to be the currency of future. So down the line, next 10 years, or maybe our generation or our children may see that as a very regular currency for future. So yes, if you're thinking about investing or should you invest, if you're asking me, yes, it is a good way of investment. Is it risky or not? Yes, at this point of time, it can be risky, but then, depending upon your personal choice, how much risk can you take? You can invest that much, So some people have made money putting money in Dogecoin or Bitcoin for that matter, and they're investing some other currencies that are coming up slowly. And some people are keeping away from their, keeping in mind that cryptocurrency is being banished by all the state regulations and countries. They do not want cryptos to come in, for a very simple reason, is because, say for example, USA, right? Whenever world economy is discussed or trading is done, they do it in US dollars. If cryptocurrency comes into play and people start dealing in cryptos, then US dollar will lose value. So that is one of the reasons why governments are bashing it and they don't want to use cryptos.
So what is the concept of taxes? Is it in the middle bucket or the last bucket when it comes to crypto?
When it comes to what?
So when you are trying to distribute crypto or when you try to withdraw crypto, the taxes fall in the middle bucket that you showed from diversification, or is it in the
It
last
falls
bucket?
in middle bucket. Yeah, it falls in middle bucket. Crypto basically is not also, it will fall in the first bucket actually, tax now bucket, because if you do crypto, you're trading again. And so whatever money you're making, you're liable for taxes on that. So you'll be on the first bucket. The only two things that are on tax advantage bucket, which is tax free, technically is the Roth IRA, where there is a limit of $6,000 per person, and bonds. But bonds is a days of, is a product of past. Nobody invests in bond anymore. Pension plan is all gone. Nobody is talking about pensions anymore. So only other product available is a life insurance retirement plan, or another plan called 7702 from IRS. But yeah, you should diversify in all three buckets, according to me, because you don't want to overfund on 401k or 403b, because you'll pay a lot of taxes at the end of it.
Mhm.
Any other
Wonderful.
questions?
No, I think this was really good. If anybody has any questions, you can definitely unmute yourself and ask the question or put the question in the chat. We will monitor the chat as well. We'll give just another 30 seconds to see if any question is coming up. But I think we're at the end of our program. It was amazing. Thank you for that, because I really knew this was going to be a little advanced class, and this was indeed an advanced class, and we needed it. So that's why we need the recording, so we can recall everything, because there was a lot of information, good information, I should say. So thank you.
Thank you again. And as I said, I mean, feel free, reach out to us. Our mission is just that we want to make sure that no families are left behind.
Perfect. All right. Well, this concludes our program. Roshan, any last words from you, or?
No, I just I wanted to say that I would prefer texting, because there are so
Texting.
many marketing calls. I would not be able to differentiate.
Absolutely. Absolutely.
That's it. Yeah.
And I can say that Roshan is very quick at responses. She's very responsive. So
Yes.
please do take the advantage of their free consultation that they're providing.
Sure.
And is this
Yeah.
one last question? Is this national, or are y'all going to stay local? Because there are some
We are
folks on the
national.
call that are national. So I want to make
So
sure
we are
that.
national. Yeah, we can do anywhere in the country. Yeah.
Mhm.
Wonderful. Wonderful. Well, thank you so much once again. Appreciate each one of y'all joining, and thank you, Mr. Salim and Roshan, for this. I appreciate
No,
y'all.
thank you again for the opportunity, and I'm glad everybody participated. I hope it allows them to make a good decisions for their future. Yeah.
Yeah.
Absolutely.
Thank you,
All right.
everyone.
Thank you
All
again.
right. Thank you so much.
Thank you.
Take care.
Thank you.
Bye bye.
Bye-bye.